And Ari, welcome back to Fast Forward.
It's a pleasure to be here.
You joined us back in February when everyone was focused on events in the Middle East.
Right.
And you were focused on events in Europe. Are you still focused on Europe as really sort of the hotbed of risk activity, if you will, or are you looking to where Europe will spread to? I mean, we're looking at Greece, but we were also talking about Ireland. What are you focused on right now?
See, there are many risks. On the aspect of Europe, I think that the market understands that something will happen. The big question is when, how is it going to affect, and who is going to be affected? I think it's unclear, and I think there will be a lot of surprises that a lot more people than people expect are going to be affected. And you've got to be prepared for the aftershocks.
Who will be affected? So we're waiting for confirmation on this, but we are expecting to hear from Greece's prime minister potentially stepping aside or offering to step aside. Is that something that you've been talking to your clients about, that potential, and what does that mean?
I think that Greece is a fait accompli. Meaning we're going to have some kind of a restructuring. The question is when, how, and who's going to be affected. I think the next one's in line, the contagion, is the big issue. And the question is, it's very unclear who holds those bonds. You realize that a bank, all the banking system is very fluid. So the transmission mechanism allows it to go to places that you least expect. And I think that that will be the surprise, and that's the question that's not answered yet.
Do you think that's what the European finance ministers are trying to figure out before they come up with a definitive suggestion as to how to structure a next bailout for Greece? They're trying to figure out who exactly holds the debt?
I think it's who exactly holds the debt, who gets affected by the debt. You might not even hold the debt and be affected by it.
How would that happen?
Look at what happened to Lehman and AIG, right? Lehman went under. I think regulators were expecting. The surprise was what happened to AIG, because when Lehman went down, it triggered the CDSs, which led to AIG being downgraded, which meant the AIG had to post collateral, like 4 steps removed. But they could have never expected that to happen day one. I think that this is the big issue here. Even though AIG probably had nothing, only CDSs, where are the skeletons in the closet in Europe? Who has exposure to Greece? And the question is, who are the next dominoes to fall and how they're going to affect?
Now, the rating agencies seem to be trying to stay ahead of this, right? We heard about an announcement that the French banks potentially are going to be reviewed, that we should watch for downgrade there because they're holders of Greek debt. We've already heard about Spanish banks being affected, but this is what you focus on, and you have a lot of data available to you. You have a lot of various clients that are very savvy that you speak to. Where are they focused, and where could this lead next?
I think that we are all focusing on the non-obvious channels out there. I mean, you've got to realize that this will affect the banking industry as a whole, even in the countries which appear to be safe. Safety is going to be challenged. I think that the risk people are focusing on, but I think there's a misapprehension, a misunderstanding of what is really safe. So we are focusing, is safety really safe?
U.S. Treasuries.
U.S. Treasuries is one of them, but U.S. banks, banks in other European countries, out of the periphery, out of the core, how safe are those? Meaning, where are the skeletons and what is the next problem to show up?
Is cash safe?
That's a big question. Probably cash might be the least safe of all.
Why is that?
We see in the US, we are now going to the next step, which is stagflation. Stagflation is something which is extremely difficult for central banks to actually tackle. And the question is, as we see, we have inflation, cash is depreciating, and you've got to make returns. The problem is most returns are below inflation. So you're forced to take risk. You're taking risk at a time when it's probably the most dangerous to take risk. So you've got to play that. But cash in itself is depreciating because we have zero interest rates, we have a zero bound rate environment, with inflation building out there. We've seen the numbers today, and that's only going to continue.
All right, Ari, pleasure to have you on.